companies as opposed to banks is fairly, well, at least uncertain, if not bleak.
Well, I mean, it's always fun to talk to people, and I'm sure to talk to you. Let me give you a different view. You know, we do have a foreign banking system. It focuses on certain things as product lines. By and large, the major banks don't focus on the traditional line of business that South Canterbury has. And I'd stop and put a pin in for a minute and say when South Canterbury varied from its traditional line of business, there are a couple of areas where it's gotten clobbered and we've just paid the price and let's discontinued activities and we'll get out of it. But the core rural-based business of lending on tractors, debt consolidation, consumer, farm loans, been a very healthy business for us for decades, and that portfolio remains by and large very, very healthy. So we see this as a back to basics and something that we do that banks don't do. That sector of the market had some service over the years through finance companies. We all know that a lot of that competition is gone or going or not able to do anything, not able to fund itself well, not in good shape or disappeared. And there are now greater regulations and strong barriers to entry. So we actually figured we'll be very well positioned as a strong survivor with a good brand, good reputation, well capitalized to be in that sector and operate with less competition in an area that really needs servicing. The feedback we get from our client base is that banks are not getting their mind around saying yes to a few more cows and a few more tractors and here and there, and that's our business and we aim to be in it, and we think it'll be very good business for us.
Just looking
Make sense?
Yeah. I wonder, though, whether with the new Reserve Bank rules that you will need so much extra capital that you'll struggle towards the end of this year, early next year, to restructure to have the capital adequacy the Reserve Bank needs. I'm wondering how you're going to address that capital adequacy issue.
Well, the Reserve Bank adequacy is one of those very interesting barriers to entry that I talk about. You do need to be adequately capitalized, and people are more specific about that. And we've got to figure out a way to get compliant with that so we can stay in the game. And a lot of the commentators have said, you know, if you take the existing South Canterbury finance and push it into that mold, you are going to need a ton of capital, and where would it come from? And unquestionably, that's right if you run the numbers. But it's sort of like saying to me, if I get in my car and head for a brick wall at 60 miles an hour, I will get seriously hurt. Well, that's not the way I run my car, and it's not the way I'm going to run the business. So, in short, what we need to do in the business is split the business into segments. And I've talked about this internally and externally, and we've begun to do it. Into a sort of a good company, which will be close to $1 billion of compliant assets that are very financeable. We could seek partners in that. We could attract capital in that. It will have a certain amount of capital, and it'll fit the bill. There's a second pile of assets that are discontinued activities like classically the larger real estate loans, where we haven't done well at it. We've just provisioned them down to a level which we hope is a good level, and those will be managed for disposal. I've got people interested in buying that book. I don't know whether I'll sell, but that's a profitable activity once you get it down and you've paid your dues. It's not a line of business you'd long for, but where we are, separated out outside of the deposit-taking regime, it can be dealt with. It shouldn't be dealt with within the finance company. It doesn't have to be. And then we've got the last category of several $100 million of things like South Island Farm Holdings and Dairy Holdings, which aren't good loans, and they're not bad loans. They're actual equity interests with some loans attached. And those need a different type of management and a different type of home and a different type of holder. So over time, we will begin to manage those things on a segmented basis. And you'll find that depending on how we do it, that the amount of capital may not be anything like the kind of rumors of, 600% of this and 400% of that. That would be a dumb way to do it.
So do you think you could actually get by separating the good bank out from the bad bank and the investments and not having to raise extra capital to back the good bank?
Mathematically, depending on how you do it, we might get by with little or no capital. My suspicion is that in order to make it all go, and there's a lot of variation in this, values move around, the market moves around, we probably will raise some more capital. That's not unusual, nor is it a sin. Businesses that are growing and going through change raise capital. We've done 3 capital raisings in the last few months. I've always said to the market that we're not done. One, the helicopter and scales transaction, has been large by any standard, and in the family, the other 2 have been small and involve parties that have supported us in the past. Those are not the only things we could do, and if we want to grow and do this, we may want to do some more.
Now, Torchlight have lent money to South Canterbury Finance. George Kerr is the main player behind that, and Pine Corporation. Can you explain how it now has a first ranking claim on the assets inside South Canterbury ahead of the debenture holders, and whether that's a risk for investors?
I can explain. I mean, first of all, let me say that George is a very interesting businessman. He's got some declared intentions in a lot of directions. We have appreciated dealing with him, and we've appreciated his help when, frankly, a lot of other people weren't around. And that's been good business, I think, for all of us. Where it may go in the future is a question that George holds the key to every bit as much as ourselves, maybe more. How do the priorities work? Under the debenture trust, there has always been an established ability, and it's not unusual in these trusts at all, for a reserved position ahead of people. It gives a lot of flexibility. It's always been there. It is sort of like, Bernard, a facility on your house where you'd say, well, I have a rotating loan that has a mortgage and I've got a steady facility behind it. And people draw that down. It's very common in the U.S., for example. But if you think of it in those terms, that's what it is. Now, it's not unlimited. It's quite prescribed. What can go in there and how much can go in there at a given time is set by regulation. So the trustee, management, and investors knew, or always should have known, because it was quite visible, that there could be a position in front of a certain amount. It could be zero if we don't use it, or it could go up to the max. So in the days when we did a couple of deals with George and others, we have used that. It's totally normal. We would continue to use it. It's as we go forward and diversify funding sources, will we draw it down? All options. But there's nothing unusual. There's nothing that's not transparent. There's nothing sinister in it. It has always been a reserved position for our use. And it's quite handy because when you use that, that first tranche position, a lot of people don't have to worry about where they are in line. But the debenture holders have always been theoretically behind that amount. It's not a very big amount. It's 7.5% of the total.
Can you understand, though, when investors see an ad that might say secured first ranking debenture, and when they've seen in the past the likes of Fortress Capital jump into that position at the front of the queue, and they've lost out, and Fortress is zipped off and being paid. Is Torchlight becoming the new Fortress here, and is there a danger with that?
I don't know enough about the Fortress situation to comment intelligently. That's more a question for those guys to answer. But our first position is extremely limited. I mean, you will just not get hundreds of millions of dollars of people losing their money because 7.5% of the money is ahead of them. It's defined. It's administered and run very hard, and right now we're subject to a lot of scrutiny. So, believe me, the auditors and the trustee and every man and his dog test that position to make sure that people don't end up behind anything more than the original bargain. And, there's another sort of twist to this. One of the big differentiators, I think one of the things you need to focus on is that the management, the board of South Canterbury are of a nature and of an independence that's just not on the radar. We're going to run this thing according to its documents.
Now, the auditor in the prospectus said there were some issues around the going concern aspect of the company. Can you explain what the difference of opinion is between the board and management and the auditors about that going concern assumption?
I don't think that there are huge differences of opinion around some of those assumptions. Let's put it back in context. It's an unqualified opinion. And, that's what you look for when you open up these audits. You say, are they giving us the seal of approval or are they not? And this has the seal of approval of EY. We were delighted with the process. It was a hard process, and it tested us. It ran us right to the line in time and money and effort and a little bit beyond.